class on patterns. The pattern today I'll cover is the Gartley pattern, one of my favorite patterns, which is it's just a retracement pattern. Okay, so last week we covered a 79% pullback, which is also obviously just a very deep retracement pattern. The Gartley pattern is very similar, except the structure between the low and high and the pullback is different. Okay, so before we're going, as always, let's just run through the disclaimer. Spread buying forex and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. Trading of these products may not be suitable for everyone, so please ensure you understand all the risks associated with trading. Information and comments provided here and in no circumstances are to be considered an offer or solicitation to invest, and all information provided is believed to be accurate at the date the information is produced. Nothing here should be construed as investment advice, and information provided within the room is the personal opinion of the moderator and not Tradimo. This content does not constitute financial, investment, or tax advice, and Tradimo does not accept any liability for the content of the comments made during the session. So what I'll do is I'll bring up a chart. I'll just clear the charts up, just a blank chart, and very simply I want to run over what the pattern is. So essentially what we're looking at is it's a retracement pattern, which means we obviously have to have something to retrace. Now, what we're looking for is we're looking for the first leg of the move. Now, the Gartley pattern, as with some of the other harmonic patterns, are labeled in a 5-point structure. Okay, what we're looking at, and we should probably actually start with the AB equals CD pattern. However, I'll show you the Gartley pattern as a retracement pattern first, and I'll show you kind of how we can bypass the middle part for now. So what we're looking at is an initial thrust. Okay, in this case we're just looking at a down leg. Okay, remember last week we spoke about those 79% retracements, and we spoke about obviously different ways of looking at them. So we can either find them at key levels of support or resistance as reversal structures, or inside a trend. Okay, so we're just looking for a deep pullback in a trend. The Gartley pattern is no different. Okay, I want to find it at key levels. The way I trade it, I want to find it at key levels of support and resistance. Okay, or I want to find it inside a trend, but I want it to complete at a key area of resistance. Okay, that's just my preference to the way I like to trade the pattern. So I'm not, when I show you the pattern now, there's different ways of identifying the pattern. Okay, there's no right or wrong way. When you start looking at or start doing a bit of research, if the pattern sort of appeals to you, you'll find that there's no right or wrong way. The Gartley pattern was initially discovered by a gentleman called H.M. Gartley, and he discovered it a long time ago. Okay, that's in 1920 odd or something. Basically, he just looked for a pullback in a trend, and he had it labeled something to this effect here. Okay, so he basically looks at something like this. This would be the reversal pattern. We have the initial drive down, and then we have this leg being the first retracement, then the next retracement, and then further a deeper retracement. And what they would look for is this leg here to be equal to this leg. So we would, when we label this, this would be A, B equals C, D. These two legs would be equal. Okay, I'm personally not, I do keep an eye on it, but I'm personally not that strict when I trade the pattern, and I'll show you why. Because I use confidence. Okay, my trading is all about confidence. When I have fib confidence, I'm still keen on the trade if it's at a key area. Now, digressing a little bit, in terms of the pattern itself, initially what I'm looking for is a clean move down or up. Okay, in this case we're looking at a down move, and very simply I'm going to teach you the structure of the pattern. If I drop a fib from the high down to the low like we did last week, the way we would label this is very simply the first point is point X. Okay, this part, the starting point of the pattern is point X, and then we move down to point A. Okay, So this is the initial drive, and this is what we're talking about when we talk about an impulsive move. We're looking for a nice, very clean move, okay? It's not all choppy and zigzaggy, okay? The cleaner this move, the higher the probability is that this is the dominant force in the market, okay? What we're then looking for is, we're looking for an initial retracement. Now, this is where it kind of gets a little bit more, I wouldn't say tricky, but a little bit more discretion, because different guys, depending on where you're learning the pattern, will teach it differently, okay? Larry Pesavento is probably the king of the pattern. He's not as strict as some of the other guys when looking at the actual retracement. Okay, what he's very much interested in is an A, B. So he's looking at this leg here. Okay, so he's looking at this leg, this from A up to a retracement point. It can be basically any type of retracement, really. But he's looking for this retracement, which we call A, B. So when we get to the labeling point, okay, so now we have XA being the initial leg, AB being the initial retracement of the AB leg. Now, as I said, depending on where you learn it, the pattern, if you learn it from basically the founder of the pattern, well, H.M. Gartley was the originator. Larry Pesavento was the guy that kind of introduced it to the world and started adding in Fibonacci and labeling it with this XABCD formation that you'll see if you type the pattern in on Google, okay? But this retracement here, when it ends at a retracement, we're looking for a pullback, okay? And this pullback would be point C at some point where it stops. So you would have the initial move of X to A, then A to B, B to C would then be in a retracement of the AB swing, okay? And very simply, the way Larry Pesavento would show it is he would look at this AB leg equal to the CD leg, okay? So depending on where this initial retracement stopped, so if, for example, let's say it stopped over here, okay, let's say it stopped at the 38%, and then retraced down, then he would very simply look at AB and then the CD formation, and you would label this as such, and he would be looking in this instance at a completion point around the 50%, okay, or slightly above it, 618. Now, the main focus there would be for him to say this AB is equal to CD. Okay, so these two legs are equal in distance and in time. When we talk about time, we're talking about actual candle bars, okay, or bars or candles. So the amount of time it takes, so let's say it takes 10 bars here, we'd be looking at, you know, similar, maybe 10, 11, 12 bars in this leg, okay. However, you know, we're starting to get like really complex here, and personally, I don't find you need to be this specific with the pattern. Scott Carney he was one of the students of Larry Pesavento, and he went a step further and said basically the B leg has to stop at the 618, okay. So he says the retrace from AB, so basically XA is the same, but the AB leg, which is the retracement of XA, it has to stop at the 618, okay. And then he says when it starts to retrace, I'm just going to adjust this, when it starts to retrace back down, the only area that I can complete at, and then you're looking to trade from, is the 786, okay. And what he's looking for, same thing again, he's looking for this pattern, the AB equal the CD, okay, that would kind of look like this. So A, B, C, and they're looking to trade it at the D point, which is the 786, okay. So the 786 retracement. So that's the format of the pattern. We've got this initial move, we then rally up stalls at the 618, it retraces, and then it gets a further push to the 786, and we wanted this AB equal to CD. Okay, now there's another step to this where we're looking to draw a Fibonacci retracement. Now, I personally draw it from A to B. Okay, that's the way I do it. That's the way I was taught. So I'm drawing the Fib tool from A to B swing. Price retraces 38, 50, 618, 70, 786, and then rallies. And you see, in terms of, I don't know if I can zoom this up a little bit. No, we can't. In terms of the actual retracements and extensions, you'll see how we have the 786 retracement lining up with a 127 extension. Okay, so those two numbers there are very important, and that's my main focus. Okay, so when I'm trading the pattern, I'm personally not that focused on this AB equals CD formation. I'm more focused at this confluence area and higher time frame areas of support and resistance. Okay, that to me is the key point. But as I said, everyone does it a little bit differently, and you'll see if you looked at these textbooks or did a bit of research on these patterns can be found anywhere. As I said, I want to see them found at key areas of support and resistance. Okay, that's just the way I like to play the pattern. So that's essentially the pattern. As I said, I draw my fib from A to B, looking at the 127 extension this way projected to the upside. What you'll find in the textbooks is they'll draw from B to C, and they're looking at this extensions, and they're looking at between a 127 and a 1618. So depending on how deep this swing is, for example, that will vary depending on how deep the swing is. Okay, but essentially they're looking at drawing an extension from B to C and looking at the extension as we mentioned when we ran over extensions. Okay, so in terms of what I personally look for, I'm looking at the 127 extension, and what you'll find the way I draw it and the way I'm going to show you to basically you draw it from this A-B swing, you'll always find, as long as price stalls at the 618 and it pulls back, you'll always find it lines up with a 786 and the 127. Okay, if you draw from this upswing, that's just the way it will always line up. Okay, so as I said, I've been trading this pattern for a long time, and this is the way I trade it. However, I do trade it around key levels of support resistance, so that is a factor. I want to take the whole market action, the whole price action into account. All right, I'm not that fussed about a B leg must equal A B leg must equal the CD leg, and these bars here must have be the same amount of bars here. That to me, it's not something that I kind of focus on. All right, I'm not saying if it works for you, that's absolutely great. What I would say in terms of symmetry, and I'll show you another way of working this pattern is, instead of looking at any type of extension move, okay, you very simply, another gentleman, also a very good book, is he wrote, and he's been studying and trading pattern for a long time, also a student of Larry's, is a gentleman by the name of Ross Beck. Okay, and he's written a book just on Gartley patterns. Now his pattern is, he's not overly focused on what the initial retracement is. Okay, so for him, it can retrace, it doesn't even have to retrace to 38% and sort of retrace and then fall. He is just focused on the main aspect for him is he wants it to complete at the 786, and he's looking for an AB equals CD format. Okay, so depending, that's kind of his preference, depending on, and you can play around with these numbers. Like for example, if you looked at price stalling here at the 38%, it's going to have a very shallow retracement here for you to get kind of an ABCD formation. Okay, very, very shallow. That's you're not even gonna make it. So he's not too focused on the initial retracement. As I said, the main focus for him is going to be where the completion point is, and that it has an AB equals CD formation. So this swing here, that's what his main focus is on. Okay. And he basically, all he does, instead of drawing the extension on here, all he does is very simply, he has the initial retracement, and then he'll very simply just draw, or follow price, should I say, but he's always looking at the 786, and he's just always copying this leg here. He'll just copy it and he'll paste it over like that, and that's kind of what he'll be looking for the completion point. Okay, something like that. So very, very straightforward. If, for example, it's retraced to the 618, then he would basically look at kind of AB equals CD, and you can see obviously the retracement would be, you know, deeper in this case, right? So as I said, there's no one specific way to trade the pattern. I've been taught to trade the pattern from this angle here. So if price rallies from A up, it can stall at the 50%. Okay, this is kind of how I used to trade the pattern. If you draw your fib tool from this swing up, you will see basically the 1618 extension lines up with the 786 area. Okay, so as long as price retraces to this 38% or below, this would still be valid. However, obviously you're not going to get an AB equals CD formation like this, but in terms of the confluence, okay, you're going to have nice confluence here. So that's why I say to me, there's literally a load of different ways of doing it. The preference now for me personally is, as I said, I'm personally not that focused on the AB equals CD formation. What I am interested in is the 786 and 127 extension coming in alignment. Okay, so in order for them to do that, drawn like this, I must have price move up to the 618 extension. Oh, sorry, retracement. Okay, so it would look like this. Okay, so X, A, B stalls at the 618, retraces. I'm not phased where it retraces to, but it pulls back, and I'm entering at the 786 with the extension of the 127 extension, finding confluence. Okay, so that's a bearish pattern. Okay, so when this completes here, I'm looking to sell short. Okay, so I'm looking to sell short. It's a bearish pattern, right? So hopefully that makes sense to you guys. Okay. Now, in terms of a bullish pattern, okay, very simply, we start with a leg up. Okay, so we have this initial move up. Okay. And if we draw a fib from the low up to the high, we have, excuse me, we have price stalling out, or starting, sorry, should I say, at X, and then it rallies up to A. Sorry, not sure what happened there. Okay, so we have X to A. This is what we term a impulse move. That's a nice clear-cut move. So when we start looking at candles, I'll show you what I mean by that. Then price retraces to the 618. Okay. And then I'm looking for it to start retracing back up towards A. And I'm drawing a fib from this swing down. Okay. And you'll see once again the 786 and 127 extension come into alignment. And I'm looking to take a trade at this area here. Okay, looking for a buy. Now, what I didn't mention is there are a couple rules in terms of what qualifies the pattern. That's what makes this pattern very nice. Is there's very specific retracement rules. There's a lot more if you could do it the absolute textbook way. As I've just shown you, I'm not personally that fussed about it, but each their own. I'm just showing you the way I trade it. But essentially, the rules are, okay, from X to A, price retraces. What I'm looking for is around the 618 area, okay? So between kind of if price spiked and it came very close to the 618, I would class that as long as those extensions, that 127 extension comes close to the 786, I would still be keen on that, all right? So I'm not, it has to absolutely hit the 618. If it misses it by a few pips and pulls back and those retracement and extension levels line up very close, that's what I'm after, okay? So that's really what I'm looking for. Now, in terms of the retracement, what should we be looking at to kind of decide whether the pattern is invalidated or not? Well, very simply, if I've identified a strong leg, in this case X to A in the market, and price moves down, okay, this initial AB leg, all right, this retracement, if it retraces past the 618 area, okay, this is the way I trade it, right? If it retraces past the 618, so if it goes like 70.7 or 786, then I'm no longer interested in a Gartley pattern, right? That's straightforward. If you went and studied Larry Pesavento books, very simply, he'll have it as the AB leg cannot retrace past point X, okay? So for him, he would still, I'm not going to take all that, he would still consider, or he still trades the pattern if price pulls all the way back to this area here. So this here would be point X. So it would basically form a double bottom. Now it is a very, he mentions it as being a very rare pattern. Okay, but for him, that's still valid because he would still be looking, at this area here, and then he would focus on kind of this AB equals CD pattern, something to this effect, trading in it, I don't know, 786 area, something like that. Okay, so he's obviously got his specific rules. I've got mine, and for me, if I'm looking at a pattern in the market and price breaks past the 618, then I'm not looking at a Gartley. Okay. So yeah, I'll show you the butterfly. I don't really want to go in the butterfly this, but I'll show you an exact example because we're looking at one on the euro here, and I'll show you kind of how you can differentiate. But I'll break those patterns down as we go. So the XA swing price for me, I want to look at it stalling around the 618. If it goes beyond the 618, then I'm not looking for Gartley. Okay, so that's a very specific rule for me. Now, if price comes down and hits a 618 and it starts to retrace, okay, for me it has to hit a minimum of a 38% retracement of A to B. Okay, if it doesn't, then this extension here for me is not valid. Okay, because I don't have it retracing to. If it does something like this and it doesn't come near the 38 and then it drops down, that to me is not a valid pattern. It has to trade to a minimum of a 38%, okay, and it can trade to any of the retracements, but minimum 38%, okay, so pretty straightforward there. It can't retrace past point A. If it retraces on this pullback from A to B, this retracement, if it retraces past A, it's no longer valid as a Gartley pattern. So you can see the retracements are very specific in terms of, am I looking at a Gartley pattern or not? Right? So pretty straightforward. And then what I'm looking for is the completion point C to D to move down to the 786. So the 786 area is where I'm looking to take the trade. Okay, that's my entry. My stop loss, as we mentioned last week, trading those other patterns, is going to go below point X. Okay, so if price shifts down beyond point X, the pattern is no longer valid. Okay, and then, because the pattern's no longer valid, I'll be out of the trade. All right, so straightforward, really. Okay, so I've got very specific risk parameters. Okay, now we've got our entry point, we've got our stop loss. Okay, now how do we work take profits? Well, take profits, as with anything we trade, any methodology we trade, it's obviously it's very specific to the trader, right? Maybe you want to just scalp the thing, maybe you're looking for home runs, maybe you're looking for big swing trades. Whatever the case is, you need to find what suits you. Now, what I do personally is I will look at this swing. So once I've found point D, so it could be at the 786, maybe price bleeds through a little bit and finds support at the 886, in and around this area. As long as it kind of finds support and it starts to turn, once we start getting a bounce, what I will do then is very simply draw a Fibonacci retracement from point A to point D. Okay, so from point A here down to point D here is, I'll just change the color on this so you guys see the swing. This is the swing that I'll be drawing my retracement on. So basically this new swing here where price starts to turn off from this high down to this low is where I draw the fib. So from A to D, and very simply what I'm looking at, and obviously there's different ways of doing this, I'm looking at a take profit at the 618 retracement of A to D. Okay, and when price gets to the 38%, my stop goes to break even. Okay, and what you will notice, as I mentioned last week when trading those other patterns, if you're trading at 786, target 50%, you'll see that 50 and the 38 are basically going to come in, very, very close, if not the same number, depending on the market structure. Okay, so you could make it the 50% if you wanted from the XA swing. However, I just from A to D, 38% is break even. Target is a 618. Okay. Now I've also traded it before without drawing any kind of retracement and simply just looking up towards just short of the highs. Okay. Not targeting specific at the high, but just targeting kind of just below the high. So it would be probably around about, if we drew a fib from A to D, I'd probably be looking at the 786 to 886 zone. Okay, and I'd look for some sort of support resistance area to align with that area. Okay, so that's another option. The other option, which doesn't get hit very often, for the extension all the way up here. Okay, so you enter here at the 786, and your target is all the way up here. Right, but obviously price has a lot to move through. It's got all this resistance to get through, break the highs, and obviously go to the target. It doesn't happen very often, but obviously when it does, you're getting very, very good risk reward. So in this case, you would have a stop of, I'm just using the structure on the chart here, but you'd have like 16 pips of risk, and you'll be targeting like 64 pips profit. Okay, so you'll see obviously the risk reward is very good. If you targeted the highs here, you'd have like 40 pips for 16. Okay, as I said, it doesn't, always remember in trading, the bigger your risk reward, okay, your target, the less often it's going to get hit. Okay, that's just the way it works. So if you're going for 1-to-1, you can get, your 80%, 85, maybe 9% hit rate, depending on how good you are and how good your methodology is. If you start trading, big risk reward, 2.5, 3, 4, 5, you'll see your hit rate gets smaller and smaller and smaller until eventually, maybe you're down at like, I don't know, 25, 30%. And you don't need to, maybe even 40%. I think when I was keeping strict tracking, when I was tracking the stuff originally, I think I got it around the 40% mark. Okay, and that was targeting kind of up here in this area, and that's when I sort of started out. So, and as with anything, you kind of get better with spotting patterns and trading patterns, and getting a feel for when you should trade the pattern and when not. Okay, so that's essentially the pattern. We've just shown you the short and long, and obviously I've just shown you take profits for a buying example. Obviously just reverse it for a short example. Okay, so essentially if we have a look at this, I'll just show you the structure here. And as I said, everyone's going to do it a little bit differently. This is the way I trade it. This is the way I have been trading, and this is the way that works for me. If you want to go look, very specific textbook, beautiful patterns, that's fine. Just understand you're not going to trade very often, okay? Now, if we have a look at this move down, this swing here, from here to here, I just want to draw this in. I double check that this is actually the swing. Yeah. So this would be the initial swing. You can see how the candles, if you look at the candles here, look how long these candles are, okay? Very nice long candles. This would be my initial leg, okay? So if I label this would be point X. This would be point A. Okay, pretty straightforward. And once I've got those points, I would then draw my Fibonacci retracement from the high down to the low. All right. So now what we're looking for is we're looking for a retracement to point B, and I'm looking specifically at a 618 retracement. Okay. So price moves up, it's a 38%, drops a little bit, moves through, hits the 618, and retraces. Okay. So on this retracement here, once I've got this retracement, so essentially we're looking at from here to here. Okay, I will draw my fib from A up to B, and remember I'm looking for, so this is now point B. Once I've got a retracement to a minimum of a 38%, okay, that's my rule, minimum 38. In this case, you see it retraces to the 50%. All right. So I've got a 618 retracement of the XA swing. Price then drops off and it retraces a minimum of 38, in this case 50. That's fine. So the rule's met. Now what I'm looking at is I'm looking for a move up, and I'm looking at an entry point at the 786. So have a look at the 786 retracement with the 127 extension. That's my sell zone, okay? That's my sell zone there. Very, very nice tight little area. Okay, right in there of 2 pips, right? So I would put a limit order in the market at the 786, and I'm looking for price to surge up, and you can see price obviously surges up into the level, bang, and we get immediate reaction, okay? Immediate reaction, and you'll see how in terms of orders, I put a limit order. This is the way I trade it. Limit order, stop loss above point X. Okay. So once price reacts to, so let's just label this A, B, C, D. So D is the completion point. So XA is the initial swing down. AB is the initial retracement, BC is the retracement of the AB leg, CD is the important leg for me, and that's where I'm looking to take the short from, okay? So the confluence of the 786 and the 127 extension is what I'm looking at. Now, why would I be interested in that confluence? Well, if you think about it, the retracements 38, 50, 618, 7.7, 786, 886. The retracements are where new sellers are going to come in at, right? So the 786 is where I'm looking at new sellers coming in. Okay, anybody that's gone long down here, so let's say for whatever reason we think this is a good buy down here, and I want to buy it at the 50% for whatever reason. So price from A to B, price retraces 50%. I'm buying it here. Okay, my target, I want to target up at the 786 area, or sorry, beg your pardon, at the 127 extension. So I'm actually going to target an extension. That's why I remember when I spoke about extensions in the week, the extensions in this case 127 would be up here. All right. So if I've bought on a retracement, okay, in terms of taking profits, what do you have to do? If I've bought down here, in order to take profits, I need to sell my position back. So now what's essentially happening at point D is we've got sellers from a retracement area, okay, as well as we have buyers who are selling at the 127 area. Okay, so you have a stack of sellers essentially coming in at this area, and this is kind of a move down. Now, once we start getting the move down from D, okay, very simply, I want to draw a swing from A up to D turning point, and you'll only know that when price actually starts to retrace a little bit. And then we'll draw a fib from A to D. Okay, and now when price hits the 38% break even, okay, so we now, if this is our stop loss, if that's our stop loss, as soon as price hits the 38 of the A to D leg, I can now move my stop loss to entry. Okay, and very simply, the take profit is at the 618 area. Okay, take profit 618. So in this case, you would have bagged yourself 45 pips and you're risking about 20, 25, somewhere around there. If you wanted to target lower down, you'll see, as I said, the lows. You see these lows here. We've got this area of support down here. Okay, that could be the target zone as well, right? And you'll see that's kind of around the 786 area, 886 area, somewhere around there. So, you know, you're going to squeeze out an extra few points, and obviously the risk reward is going to go up, you know, because then you're looking over the 2R. Okay, so that's a short opportunity. Let's have a look and see if we've got a buying opportunity. We do have a buying opportunity because I took it. If you have a look at this euro yen, okay, we have this initial move up here. All right, so this we would label as point X. This is labeled as point A. Then price starts to move down, right? So I want to draw a fib from X up to A. All right, and I'm looking at, remember, 618 for the Gartley, which is here. So price comes down to the 618 and we bounce. So we basically feed through the level by about, you know, 2 pips or something, and then we bounce. So once we hit the 618, I draw a fib from the point A down to this point here. So if we just look at this, from A down to B, so label that for you. Okay, like that. And then so we got XA is the initial swing, A to B is a 618. That's kind of where I'm looking for B to stall. Once we get a reaction to a minimum of a 38% retracement, okay, then I can start looking at trading the pattern. And you see in this case 786 127 extension is about 3 pips apart. Okay, so that's good. And as you'll notice, if you play around with these fibs, the retracement extensions, this area here, as soon as I start adjusting this level, it starts adjusting my extension. So if you'll see a price starts moving through the 618, this extension, this box here between the 786 and the 127 area, it widens up. If it comes above, you know, depending on how wide that spot is. So ideally, you want, you know, if it pings the 618, brilliant. But as I said, you know, that's picture perfect. Okay, I'm not looking for picture perfect in the market. So then price retraces, and as I said, I'm looking for a minimum of a 38%. This one comes up to the 618. So once I get it moving up to the 618 up here, and it starts to move down, I can get my order, just get rid of this and this, I get my order to enter at the 786. Stop loss is going to go below the low here, okay, and you can see this one obviously spikes down, bang, entered here. This one got a little bounce, and then we obviously had, this was when Drago came out, knocked the market a little bit, bang, but my stop was still, it came very close to the stop, but it was still in place. And then it took off like a rocket. And in terms of take profits, once we've got point D in place, so obviously I'll be looking at this being point D here, right? So I'll be looking at this as the D point here. However, that wasn't the case because we pushed deeper. So this area here, I would need to look at to draw my retracement from A. This would be D here, okay, this deeper swing. So if I took a fib tool, I would need to draw from A down to that deeper swing and take profits, you know, just very simply 38% break even, 618 take profit area. So, you know, in this case, obviously the risk reward, because the swing goes a lot deeper, kind of gets skewed a little bit, but you're looking around 40 pips for about 30 points of risk. Okay, so about 1.5 hours, somewhere around there. Okay, so that's very straightforward, very simple. Obviously, as I said, you know, in terms of discretion, I'm not looking for very, you know, picture perfect patterns. I'm focused on support resistance. Okay, that's my core element in terms of where I want to look for these patterns. Okay, very important. As I showed you, if you went and broke this pattern down, okay, every teacher or anyone that sells textbooks is going to tell you that this, you know, do you have an AB equals CD and it's the right time length and all this other jazz? You know, well, okay, this one actually did have an ABCD pattern, but in terms of the structure, okay, time wise, that was off. Okay, so as I said, you know, if you're interested in the pattern, that's great. Do a bit of research on it, play around with it, and get a good feel for kind of, you know, for the pattern itself. In terms of, let's see what else we had. Maybe there was a. This was a bit deeper. Trying to find you guys another one here quickly. Well, we've got a few minutes left. I always find locating these things much easier in real time than I do, you know, while the price is moving. This one doesn't quite work. We've this one hits, yeah, here's one that failed. In terms of the pattern structure, we have the swing up, okay, price kind of moves down, rallies, moves down further, and then moves up. So we get that 618. Okay, and this is the buy zone here. So price rallies, and then it moves all the way down here. Very aggressive move into this area here. The other thing, this is another little discretionary point. Watching price action move into this level here, okay, this can be your deciding factor if you want to trade it with a limit or like at market, or if you want to just wait for some, you know, for some sort of confirmation. Is this CD leg when it moves very aggressively like this, and you're not always going to have a choice to decide, you know, where the candle closes, etc. But you know, obviously in this case, we have this massive bearish candle here. It's a very heavy momentum candle. It normally indicates that we could see further downside potential, okay? So maybe in this case, you'd want to wait for confirmation. So, you know, that is obviously adding a little bit more discretion to it. These are not, you know, straightforward mechanical patterns where, you know, if this does this, you do that. Now, as I said, I trade these around support resistance. So I kind of need that before before I take the trade, right? Let's have a look here quickly. So this was very, very messy. This would probably still be something I would trade, okay? And here again, this is kind of, you see this drop down here. This is kind of where your textbooks and things will be like, yeah, it's a little bit on the messy side. But what I'm essentially looking at is the confluence, where we have this rally up here. You see this confluence area here, 786, 127, some resistance up here. Obviously, I'd want to note what's happening on the higher time frames, but we kind of drop off. We actually just take a higher high here, but essentially this swing up here would be the sell zone. Okay, this would be the sell zone, and take profits. You know, once we got that swing, we can look at our fibs, and you know, pretty straightforward. Profit gets nailed there for 45 pips. Risk about 30. Okay, it's about 1.5 R depending on your target. If you want to use the lows, that's also fine. Just understand the lows don't always get hit. Okay. So as I said, hopefully that's kind of, you know, clearish, sort of. Obviously here I'm really just focusing on the pattern. I'm not looking at you know, where the pattern is in terms of the support, resistance, etc. So I just want you guys to kind of understand you know, the concepts there. Here we had a move up. I don't know. No. So you see this case here. So this, you know, and this is kind of also where the discretion comes in. This leg here is very messy. This is also kind of very messy. But you see on this pullback, it pulls back to the 70.7. So it overshoots a 618, which means even if I look at the extensions on here, you see the 127 area is now lining up with the 886. So that kind of messes just the spacing between the 618 and 7.7. It messes the spacing up. So now that you see the 127 is aligned with the 886 area. Okay, so I wouldn't be trading that pattern there. So as I said, there, you know, I've got rules that I look at. The textbooks have got obviously their rules. Go and find, you know, if you, as I said, if you're interested in the pattern, go do a bit of research and stuff on it. This here, this was a nice pattern. So here we've got a rally. Then we drop down to the 618. Okay. So once price starts retracing off the 618, I can draw a fib from the high down to the low, and very simply, I'm looking for a retracement, and you'll see this. This is what I'm interested in here. Okay. So that's where I'm looking to place my entry order. And obviously here you can see, you know, we rally and very simply draw fibs. High to the low, target 618. So, you know, you're targeting about 40 odd pips stop wise, probably around 24, 25, somewhere around there. Okay. Right, now, that's the Gartley pattern done and dusted. I just want to show you, there was a question here with regards to the butterfly. Now, butterfly is just an extension pattern. I didn't really want to go into that today, but obviously with a question, the Gartley pattern is here, so price kind of rallies. And once you kind of understand the patterns and you start knowing, you know, what to look for, you can really start finding opportunities all over the place. So the first pattern here is the Gartley, the 127 and 786. That's the sell zone there. Price sells off. The Gartley pattern is the 786 127 extension is a retracement. Okay, price can't break above point X. So this is, let's just label this quickly. This is X, this is A. That, in terms of the structure, would stay the same, okay? Gartley or butterfly, makes no difference. That's the inside operation here that changes. So the Gartley would complete here at the 786. and you see in this case it sells off. Now the butterfly works from A up to B, so we're looking at a 786 retracement. All right, and what we're doing with that is, with this area here, we're now looking further up, and you'll see the extensions up here, 127, 1618. Okay, so this would be the butterfly pattern. So the butterfly pattern is the extension pattern. The Gartley is the retracement pattern. Okay, so that's the sell zone for the butterfly. Now, obviously, here again, this is not very beautiful in structure. It's not textbook, but as I said, I'm interested in the extensions. That's what I'm after, and where it's fine. And as I said, we've gone over this already. This area here was daily resistance as well as daily 50%. Kind of, it was in here somewhere. Okay. Right. Hopefully that's all cool. We can just see if there was anything else of note. I think the pound dollar also had one. Maybe not. I can't remember exactly. Yeah, so this was just got a lot of 79 retracements to it. This is another way. You could look at trading the pattern from here to here, and you'll see kind of this 1618 and 786 area lining up. Okay, that's another way you could look at trading the pattern. But you see the stall out is 50%. So between the 50 and the 618 area, you could also look at that. Okay, that's not a teaching textbook. That's just one of the ways I've been showing the pattern, and it's really just it's simply retracements and extensions. Okay, retracements and extensions. That's what it's all about. We're looking at entering at a retracement. Okay, and people that obviously are in the market looking to take profit at extensions. Okay, right, guys. So hopefully that all gels make sense. We'll cover one of the next patterns next week. One of the other patterns of interest, and we'll catch you all tomorrow. Cheers, guys. Take care.